Hi, welcome back to UI class. We are going to talk about a very hot topic. So I think the news report on Turkey's economic situations has become the headlines of global newspapers in recent days. So today's the topic is about a Turkish experiment on the theory of interest. Let's start from the fact that Turkey's property prices have risen to the highest in the world. So let me show you the residential property price index of Turkey's in the past 7 years here. Indeed, many countries have similar pattern of housing price rise after the outbreak of the pandemic, but not to the extent as Turkey's. So the chart here shows you that in October 2021, the growth rate of housing price index reached 40% per annum. So it is the highest rate of change in the world, and even excluding inflation rate, the real growth rate of housing price index of Turkey is about 16.8%. The questions today is, what are the reasons causing the house price growth in Turkey? So of course, from figure 1, the red-shaped part indicates about the strong inflation problems in Turkey, and it may account for some of the reasons why housing price would have such a strong growth. So here, another chart shows you in the past 5 years about the inflation rate of Turkey. And in just about 4.5 years' time, it surpassed 20% inflation rate twice. So one is in about 2019 and the other is in 2021. So you will find that after the outbreak of the pandemic, then inflation rate keeps on increasing. And since 2021, it started to exceed 20%. So then what makes inflation so worse in Turkey? What are the common solutions to overcome inflation first? I think it has become a common knowledge nowadays that whenever there is a high inflation, then central banks would usually increase interest rates. And the logic is simple and straightforward, because when interest rates are up, then cost of capital increase will deter people from demanding credit. And that's why then it helps to increase savings and reduce borrowing, then inflation will fall. So it's not just a theory. In fact, during the great inflation period in the United States in the 1970s and 1980, at that time, the chairman of the Federal Reserve, Paul Volcker, had indeed raised the federal rate up to 20%, and he successfully curbed the great inflation. So we really have such experience which confirms the theory of interest that interest rate increase can help to curb inflation. Here I directly quote Emanuel Baker's 2021 paragraph to show what had happened during the great inflation period and how it was developed into a stagflation. Volcker fight against the then 10% annual inflation rate with a contractionary monetary policy, courageously raised the Fed fund rate to 20% in March 1980. I think that is a very important lesson for us to learn today. Volcker knew he must take dramatic and consistent action for everyone to believe he could tame inflation. My interpretation is, it's not the inflation that is difficult to overcome. It's the expectation of increasing inflation that's difficult to overcome. Let's go back a little bit. Why inflation rate increased in the first place in the 1970s in the US? Refer back to the quotation. President Nixon had contributed to inflation by ending the gold standard in 1973. right? That is what we have discussed before about the Bretton Woods agreement. So because of that, right, then people lost the confidence of the dollars and the dollar's value plummeted on the foreign exchange market. And that makes import price higher and creating inflation. Sarcastically, at that time, the President Nixon tried to stop inflation with wage control and price control. And then it resulted in stagflation. Finally, local central bankers realized the importance of managing inflation expectations. As long as people thought prices would keep rising, they had the incentive to spend now. So the added demand drove inflation even higher. Consumers stopped spending when they realized workers would end inflation. Businesses stopped raising prices for the same reason. So that is about inflation expectation that matters, right? So the understanding about the relationship of interest rate and inflation rate is very important, which we can trace back to the famous economist Ivan Fisher's 1930s theory of interest. So it points out that, my interpretation, he points out that it's not the nominal interest rate that matters, but it's the difference between nominal interest rate and inflation rate and risk premium that matters. So the difference between nominal interest rate and inflation rate is called the real interest. Let's go back to Turkey's case. Currently, the nominal interest rate, even after cutting interest rate 4 times this year, the nominal interest rate is still very high as 14%, right? Which is very high in comparison with that of the other OECD countries. However, it's not about the absolute value of the nominal interest rate. It's the real interest rate. That's the comparison of the nominal interest rate with respect to the inflation rate. So currently, the Turkish inflation rate is higher than 20%. So in comparison, it means that the real interest rate is negative. In other words, saving will make a loss. So it discourages people from saving. They urge them to spend, to invest, or even to hoard, right? To buy assets, to hoard consumables. It's much better than savings, right? So that's the reason why if the central banks can raise interest rate to a level higher than the inflation rate to achieve a positive interest rate, then it can encourage people to save more, to borrow less, right? To spend less and to demand less, which can then, of course, right, will bring inflation down. But interestingly, the Turkish president and the central bank of Turkey do not believe the theory of interest. Instead, they try to cut interest rate to curb high inflation. So say, for example, in the past 4 months, since September 2021, the 1-week repo auction rate has been cut 4 times, 5% in total, from 19% to 14%. And of course, then it will result in a plummet of the Turkish lira, the currency. It had plunged as much as 5.6% to a record low against the US dollar on just this Thursday, after the central bank cut its policy rate. So let me show you here the chart about the policy interest rate of Turkey, and you will find a very similar pattern as the inflation rate chart above. After the outbreak of the pandemic, the interest rate has been increased right to 19%, but then since September, the interest rate was cut 4 times, and now it's 14%. So that is about real interest rate effect here. Because the inflation rates keep on increasing, but then if you cut interest rates, so it results in a serious negative real interest rate. So it discourages people to save, it encourages people to borrow, to spend, and to buy properties. It is a textbook knowledge nowadays that countries with weak economic fundamentals, such as high inflation rate, their currency will be depreciated. So let me show you about the US dollars to Turkish liras chart. Right, in the past 5 years, basically the liras, the US to Turkish liras exchange rates keep on increasing gradually. But after the outbreak of the pandemic, until about September, you will find a sudden sharp increase in the US dollars to Turkish liras exchange rate. In other words, the Turkish liras plummet 50% in just a few months' time. So it is exactly the response of the market to the central bank's actions of cutting interest rate. Right? So I think this is a very good experiment to test the theory of interest to show that when people are encouraged to spend, to invest rather than save, encourage people to borrow and to buy property, then they will result in such a high housing price. It's because when inflation rate is very high, then people have to find some assets to hedge inflation, to protect their wealth. So then they are looking for assets that would be a good hedge of inflation. As I illustrate in my previous video, inflation rate is overwhelmingly shaped by housing rents. So a high inflation rate indeed implies that housing rents have risen substantially. So people know that housing probably is a good hedge of inflation. So if they have money in bank or in cash, they would be keen to buy residential properties to hedge inflation. So I think this is a very, very good experiment to support the hypothesis that negative real interest rate cause property price hike.